Okay. Well, thanks for joining me, everybody. Obviously, with April 15th coming and going, taxes has been on the mind of a lot of people. I've had a lot of discussions around that topic here recently, so we figured we would put some things together just to try and provide some general education around taxes and different things to consider as you look into 2025 and beyond. So, since I get a lot of emails that people love my jokes every month when we do these webinars, I have to um, I have to please all of the audience here. So, Kevin, I'm gonna ask you, or I'm gonna tell you something that I told my accountant. So I
What's
was
that?
worried about how much tax I'm gonna owe, and he said, "Don't worry, it'll be gone before you know it." And he was right. But
Love
no,
it.
seriously, everybody, I am proud to pay taxes in the US. I would just say that I would be just as proud for half the money. I can hear everybody laughing. Everybody's applauding. All right, so today we're going to start us off with Kevin, who's going to take the first half of the presentation. I will go into the next half. Just FYI, if you are interested, and we'll send out information ahead of time on this, but on Thursday, May 29th, we're actually going to be doing a webinar on cybersecurity. And that's not going to be done by Kevin and I. It's going to be done by a national resource, a cybersecurity expert that we're going to send you a link to. It should be informative. Obviously, that side of the equation, the cybersecurity side, is changing a lot with AI. So we wanted to provide that general education here coming up in a few weeks. So Thursday, May 29th, you'll be getting information about that, but feel free to put that on the calendar. So without further ado, I am going to put the presentation up on the screen. If you want to just give me 1 second.
Yeah, the cybersecurity webinar, I think will be highly attended. Certainly a topic people are very in tune to. So we're excited about that as well.
And Kevin, you good with the PowerPoint?
Yeah, that looks great. Appreciate
Okay,
that.
take it away.
Well, yeah, thanks, John. Good afternoon, everyone. Appreciate you joining us for the webinar. And certainly this is one of our favorite topics. We kind of geek out on this, things like taxes. So today we're gonna cover two main areas. First, we'll examine the current tax landscape. That's the part I'll cover. And then again, we want to make sure that everyone has a clear understanding of really where we stand today and what changes may be on the horizon. And so this context is really crucial for making informed planning decisions. And then secondly, John will dive into actionable planning strategies, really keeping in mind that before you implement any of the strategies that we mentioned today, you'll want to make sure you run them by your tax advisor, as we are not authorized to provide tax advice. So a little disclaimer there. So let's begin by establishing a shared understanding of the current tax environment. So currently, we're in what many experts consider a relatively favorable tax landscape, but one that faces significant uncertainty as we approach the end of this year. So let's go ahead and examine the specific aspects of this landscape that are most relevant to the planning work that we do with our clients. Now, in diving in, the Tax Cuts and Jobs Act, which passed in late 2017, it lowered marginal rates across all brackets and doubled the standard deduction. So the increase in the standard deduction, coupled with the scale back of many popular itemized deductions, means that the vast majority of taxpayers really now claim the standard deduction rather than itemizing. Again, real quick, when you file your taxes, you compare the amount of itemized deductions that you have to the standard deduction amount, and then you select whichever one's higher. So additionally, the alternative minimum tax, which previously affected many really middle and middle upper income taxpayers, is now a concern for far less people. We're also in a very attractive estate and gift tax environment, with each individual able to shelter almost $14 million from the state and gift taxes. So again, it's important to note that there's significant uncertainty, as I mentioned before, about tax rates in 2025, when the Tax Cuts and Jobs Act is scheduled to expire, which again creates both planning challenges and also opportunities. So let's go ahead and review the key tax figures for 2025. That will really help frame our planning discussion. Currently, ordinary income tax rates range from 10% to 37%, while long-term capital gains and qualified dividend rates remain at 0%, 15, and 20. And then we have the net investment income surtax of 3.8%, 3.8% rather, and that continues to apply for higher income taxpayers. And then we have the standard deduction that stands at $15,000 for single filers and $30,000 for married filing jointly. Now, there's several limitations that do remain in place, including the $10,000 cap on state and local tax deductions. And again, you've probably heard of it before, referred to abbreviated as SALT deductions. And then we have the mortgage interest deduction that's also limited to $750,000 of aggregate debt. Also, for retirement planning, contributions have increased, which is nice. The maximum salary deferral into a retirement plan, the base is $23,500. Plus, you have a catch-up contribution for those that turn 50 by the end of the year and older, and additional catch-up contributions for those between the ages of 60 and 63. While IRA and Roth IRA contribution limits have changed from 2024 to 2025, have not changed from last year to this year. They have a base limit, and then they have an extra $1,000 for those 50 or older. Certainly we can help you understand those figures. And really that, again, provides the foundation for part of our conversation surrounding strategies that we'll be discussing. So for estate planning purposes, it's important to remember, and just that the federal estate tax features marginal rates ranging from at the low end, 18% to 40% on estates and gifts that exceed the lifetime exemption amount. In 2025, this lifetime gift and estate tax exemption stands really at a whopping $13,990,000 per individual. Additionally, individuals can make annual gifts of up to $19,000 to as many recipients as they wish, really without counting as a taxable gift or without reducing their lifetime exemption. So another important feature to remember is something called portability. And that allows a surviving spouse really to utilize their deceased spouse's unused exemption amount. So it's really a helpful provision. Now, these generous exemption amounts create significant planning opportunities, really especially with the potential for these figures to potentially be reduced substantially after this year. So as we consider the future tax landscape, it's important to understand the fiscal pressures that may drive really the need for increased government revenue. Now, as it stands now, 74% of government spending is devoted to mandatory programs and interest payments. By 2035, projected spending is expected to reach 24% of GDP, again, with GDP being measured by the total economic output of the US. And that's how we just describe the gross domestic product there. While revenues are only projected at 17%, so 24% coming in, or is 24% spending, 17 coming in, certainly creating a significant shortfall. Additionally, the Social Security Trust Fund is projected to be depleted by 2035, which will require either benefit reductions or additional revenue to keep benefits going at the full 100%. Now, we've already experienced 5 consecutive years of $1 trillion plus deficits, with the 2023 deficit reaching $1.7 trillion. Now, these fiscal pressures suggest that regardless of political outcomes, there may be a need for increased tax revenue in the coming years, which makes current tax planning certainly all the more important. So as we look ahead to the expiration of the Tax Cuts and Jobs Act, it's important to understand how tax rates could change. So this is a cool slide that shows us very clearly. So this slide shows really a comparison between the current 2025 tax rates and projected rates if the Tax Cuts and Jobs Act expires without an extension. So as you can see, for married couples filing jointly, we see potential increases across most income tax brackets. So for example, taxpayers in the $96,951 to $195,032 range. Currently pay 22%, but that would increase to 25%. And then the most significant jump, as we're looking through here, happens between 297,309 and 394,600 range, where rates could increase from, they would increase from 24% to 33%, which is a pretty big increase at 9%. And then for the highest earners, those making over $750,000, the rate would increase from 37% to 39.6%. So understanding these potential changes is really crucial for planning, especially for strategies like Roth conversions and income acceleration, or in some cases, income deferral. Now, beyond tax rates, several key provisions are set to expire at the end of this year. The standard deduction will be reduced by roughly half, returning to the pre-Tax Cuts and Jobs Act levels adjusted for inflation. The state and local tax deduction cap of $10,000, it'll be eliminated, but the P's limitation will return, and really that'll phase out deductions in that case for higher income taxpayers. Now we have miscellaneous deductions. They'll become available again for expenses exceeding 2% of adjusted gross income, and that would include things such as investment fees and unreimbursed work expenses. The alternative minimum tax will likely affect significantly more taxpayers due to lower exemption amounts and income phase-out thresholds. And perhaps the most significant for wealth transfer planning. The estate and gift tax unified lifetime exclusion amount will be reduced by roughly half. So these changes create both challenges and planning opportunities that we'll discuss more in the strategies section of this presentation. All right, so the Secure Act 2.0 introduces several important provisions affecting retirement accounts across multiple years. So we'll start back in 2023. In 2023, we saw the required minimum distribution age increase to 73, the introduction of SEP and simple Roth accounts, and a reduction in the RMD penalty. So starting last year, Roth 401k accounts are no longer subject to RMDs. Qualified charitable distributions, again, those are charitable provisions, or that's a charitable provision that allows someone age 70 and a half or over to give from their IRA directly to charity, with the charitable gift counting towards the required minimum distribution. So that QCD level is now being indexed to inflation. We have a new 401k student loan match. And what that does is it allows employers to match an employee's student loan payment with a contribution to their 401k. So that's kind of neat. And if you have unused 529 plan monies, you now have the option to transition those funds over time into a Roth IRA. And then starting this year, there are increased contribution limits for employees between the age of 60 and 63. So looking ahead to next year, for those individuals earning more than $145,000, and then they always base it on the prior year income, their catch-up contributions will be required to be funded into a Roth. And then lastly, starting in 2033, which isn't really that far off, the RMD age will increase to age 75. So as I mentioned just for a second on the last slide, a significant new planning opportunity began in 2024, and it's the ability to transfer unused 529 plan funds into a Roth IRA in the name of the 529 plan beneficiary. So up to $35,000 in unused 529 plan funds can be contributed over the beneficiary's lifetime. So as part of this, there's several important requirements. First off, the 529 plan must have been in place for at least 15 years, and the contributions and their earnings from the past 5 years cannot be rolled in. Also, these transfers are still subject to the annual IRA contribution limits and the compensation requirement. So that means that the beneficiary must have earned income at least equal to their contribution amount. Now, additionally, these transfers are not subject to the income limits that normally apply to Roth IRA contribution eligibility. Now, this option creates an excellent planning opportunity for families who may have overfunded 529 plans or whose children receive scholarships, reducing their qualified education expenses. As I also briefly alluded to a couple of slides ago, starting this year, there are enhanced catch-up contribution opportunities for retirement plan participants ages 60 through 63. So while those ages 50 to 59 can contribute an additional $1,000 to IRAs and 7,500 extra to 401k plans, which would include things like 403bs as well, 457s, etc., those ages 60 to 63 will be able to contribute significantly more to employer plans. Now, for simple IRAs, the catch-up amount increases from 3,500 to 5,250, bringing the total contribution max to 21,750. Now, for 401ks, 403bs, 457s, the catch-up increases from 7,500 to 11,250, and that would allow for a pretty good size total contribution of 34,750. So these increased contribution limits really create an opportunity for clients approaching retirement to boost their savings during these critical accumulation years. And for clients in that age range, maximizing these contributions, we certainly feel should be a priority if at all possible. So as you review your current and target retirement plan contribution levels, let us know, certainly if there's anything we can do to help with that conversation. Now, the required minimum distribution age has been increasing in recent years, and that's providing more flexibility with retirement planning. So for those born in 1950 or earlier, RMDs began at age 72 or 70 and a half for those who reached that age before 2020. But for those born between 1951 and 1959, they won't need to take an RMD until age 73. And for those born in 1960 or later, RMDs won't be required until age 75. So now this gradual increase provides really additional time for tax deferred growth, but it also creates more planning opportunities early in retirement years, which certainly John and I spent a great deal of time helping our clients review, keeping in mind, we're generally more concerned about the taxation to our clients across their lifetimes than in any specific given year. Now, the Treasury Department has issued final regulations on the Secure Act, the Secure Act's 10-year rule for inherited retirement accounts, which will be fully implemented this year. So prior to the Secure Act, a non-spouse beneficiary, so like an adult child, for instance, could stretch required distributions based on their life expectancies. Now, most non-spouse beneficiaries must distribute the funds within a 10-year period following the death of the account owner. And then the final regulations have clarified that if the account owner died before reaching their required beginning date for RMDs, so in other words, their RMDs had not started, beneficiaries can take distributions at any time within the 10-year period with no annual requirements. But if the account owner had already reached their required beginning date, again, meaning they had already started required distributions themselves, beneficiaries must take annual distributions for the first 9 years, with the remainder distributed by the end of 10 years. And certainly there's some planning surrounding this conversation, we certainly have with clients. But now these rules create important planning considerations really for account owners and their beneficiaries. And again, particularly around things like Roth conversions and various charitable giving strategies that we discuss. So now that we've established, have a good baseline on the current tax landscape, let's go ahead and shift our focus to actionable planning strategies that may be able to help you optimize tax outcomes. So to kick off the second half of the presentation today, I'm going to turn things over to my colleague, John Litcher. Go ahead and take it away, John.
Yeah, thanks, Kevin. And you're able to see the screens okay, right?
Yeah.
Okay. There's a video glitch, and I just wanted to make sure everyone could see everything. So Kevin gave a good background of the current tax lineup and what's potentially changing. And I say potential. I guess if you consider the likelihood of the Tax Cut and Jobs Act being extended, that's pretty high. Nobody really thinks that they are going to let these tax laws sunset. But as of today, that is the case. And on January 1st of next year, things change. So stay tuned. The political / tax landscape is always changing, and we'll certainly let people know if anything passes, which we do intend something to be passed here in the near future. So as we think about tax diversification, this is kind of what we talk about with our clients as we look at the different types of accounts that are available. You've got taxable accounts, which are made up of really things non-retirement based. So bank accounts is an example of a very common taxable account, savings, CDs, checking, things like that. Mutual funds and exchange traded funds, those can be held in a retirement type of account, but they can also be held in a non-retirement or taxable account. So that's a typical type of investment account that we open. And then you've got just general brokerage or investment accounts that hold a diversified portfolio of mutual funds and in ETFs. So if you think about that taxable column, benefit there is liquidity. You don't have to wait until you're age 59 and a half to get at the money. Albeit you can invest some of those dollars for more growth. So people that open up a investment account, really their goal is to earn more than what they would just hit sitting in their bank account, but they're also willing to take a little bit more time frame, a little bit more volatility to have that future growth. Other benefits of taxable accounts, you look at the tax structure of those types of accounts, and you pay what's called capital gains tax. So capital gains tax, which depending on your income level for a majority of individuals falls at 15%. That's lower than the ordinary income tax rates that Kevin was showing in an earlier slide. So that's a benefit to kind of have that lesser tax exposure. Plus, the money that you put in a non-retirement account has already been taxed in the first place. So that's called cost basis. That money will never be taxed again. Only the growth above and beyond what is put in will be taxed. And then there's a benefit from what's called a step up in basis. And that means that if you do not spend your taxable account before you die, the people that inherit those accounts do not have to pay tax on the growth like you would have. So the step up in basis is certainly a nice estate benefit that is in place now. They talk a lot about getting rid of that, but to date, that is still available. Then you move over to the tax deferred column. So there we're going to be talking about retirement plans. And if you think about retirement plans, a lot of people have their plans inside their employer. So if you work for a profit type company, that's a 401k plan. Work for a nonprofit company, it's a 403b plan. Sometimes you have pensions available. Then outside of the employer, you've got traditional IRAs. And you also have annuities that are tax deferred. And those types of tax deferred accounts provide the benefit that when you think about the snowball rolling down a hill, the IRS isn't coming in and chopping some taxes off year after year after year, like they're doing on the taxable side. You get that compounded growth, which is a huge benefit the longer you get that. So big tax benefits there. And then you benefit if you're in a lower bracket later in life, because it's better to pay taxes when you're in a lower bracket than maybe the bracket you're in today. Not everybody goes into a lower bracket in retirement, but for those that do, tax deferred retirement plans like this middle column are a very good deal. And then there's also ways to donate the distributions or donate the amount of money you have in an IRA to charity, where you don't have to pay the tax, they don't have to pay the tax. That's a special provision we'll talk about in a few slides called a QCD. But that's only available in the IRA world. It's not available in the employer plan world. On the third column, you've got tax-free dollars. You've got Roth accounts, health savings accounts, municipal bonds, 529 college savings plans. I would add life insurance in there because the growth inside life insurance can be taken out tax-free if done right. But that's obvious benefit that you don't have to pay the taxes to the government. And you also get the fact that you've got that tax deferral over time to just let that money grow. And all of that growth is tax-free. So again, you got the benefit of compounding. You can leave money to the next generation tax-free as well. They wouldn't have to pay the tax. If they inherit a retirement account, they still have to take it out over 10 years. But over that 10-year period of time, it would be tax-free growth instead of taxable. So that's a nice advantage. And then you're able to use withdrawals from those types of accounts to avoid income related penalties like eventual what we call IRMA brackets, which affect your Medicare premiums, which is a whole separate conversation in and of itself. But we're always looking at things from a retirement plan standpoint, and it's nice to have a mix of all these different types of accounts, not just tax deferred accounts, for instance, but it's nice to have some taxable accounts for bigger lump sum withdrawals in retirement. It's nice to have tax-free assets because tax-free growth is the best growth in town. And through different things like Roth conversions, you can create that either before or in retirement. So it just provides more avenues to control your taxes if you have all three of these types of accounts. So when you think about that different tax bracket structure that Kevin was sharing earlier, you start at the bottom there at 10% and you go all the way up to 37% currently. On our left is the single bracket thresholds. If you file your taxes with a single status, on the right is married filing joint thresholds. So the same levels allow you to make a little bit more money if you file taxes jointly with a spouse or what have you. So as you think about these different brackets and we look at maybe these bottom brackets, the 10% and the 12% bracket, if you or someone you know that was in that bracket, we always talk about, it's like, okay, you're not getting much in the way of pre-tax benefit. So you want to look at maybe prioritizing Roth contributions. So if you have a child or someone that's just starting off in their career that's maybe not making a lot of money yet, a lot of times if they're going to contribute to a retirement plan, it's better to be doing a Roth contribution instead of a pre-tax contribution because you just wouldn't save much in taxes anyway if you're only in the 10 or 12% bracket. You can also take advantage of the 0% capital gains rate, which again, if you have a non-retirement account, in that type of investment, you pay capital gains tax on growth. Well, if you're below this 12% bracket, the government has the capital gains tax rate set at 0%. So you could sell something and pay zero. And that's my type of tax. I like that 0%. It's just not much that allows that. When you look at if you're in retirement and you're in a really low bracket one particular year, and you're not in accumulation mode, but rather withdrawal mode, got to prioritize taking IRA distributions. You might as well fill up these buckets. 10%, very low tax to pay. 12%, very low tax to pay. You might as well take advantage of them now because they're probably not going to be there for a long time. And you really want to look at things from a tax structure as you're taking money out to maximize these low brackets. And just different things like deferring deductions and accelerating income. Those are just things that we talk about when we're looking at the low brackets. If we kind of extend up into the 22 and the 24% bracket where a lot of people fall, there's where you're looking at avoiding higher Medicare premiums by not going above certain thresholds in there. And the way that you do that is not by looking really at this bracket, is you kind of have to switch gears and look at the IRMA brackets, which have actually some different numbers in here. And that's really where we would come in and help you understand what those IRMA brackets are, if you're not familiar with what I'm talking about. You also look at partial Roth conversions. Again, if you're in the 22% bracket, and we know the brackets are going to go up to 25 later, maybe we lock in at 22. Some people would lock in at 24 because it's not hard math to say 22 and 24 are lower than 25. And if that's where brackets, if we know that's where they are going, you should be looking at Roth conversions and locking in these two tax brackets, because there's some people that will never get below the 10 and 12 just based on income they have. They're always going to be sitting in this 22 and 24 sweet spot, which it's 22 and 24 today, but those two brackets might be a lot higher in the future. So we're looking at Roth conversions in these brackets. If you're close to that 250 threshold, there's a tax that comes into play called the Medicare surtax. So you would pay an additional 3.8% on your non-retirement account investments. So we want to play the game there if you're close to that on how we can avoid that additional 3.8% on some of your growth. and then trying to maintain the lower capital gains and dividend rate by holding the investments for longer than a year, which gives you long-term capital gains versus short-term capital gains. And if you pay short-term capital gains, meaning you held the investment for less than a year, these are the short-term capital gains rate. It's the exact same as ordinary income tax. And I'd rather pay long-term capital gains at the lower rate than the rates you're seeing here. Now, on the flip side, if you are up here in the higher brackets, you look at the different things to take advantage of those brackets by maybe looking at charitable gifts, qualified charitable deductions. If you're over the age of 73 to 75, depending on when your RMD age is, starting at age 70 and a half, they allow you to do QCDs. Now, why 70 and a half? That used to be the old required minimum distribution age. Then they changed it, but they forgot to change the QCD age. So you can do that starting at age 70 and a half, and that allows you to take money directly from a pre-tax retirement asset and give it to charity with no tax obligation. And those also satisfy your required minimum distributions as you get to the age that you're forced to take money out. Look at in these brackets prioritizing pre-tax over Roth, because here you are saving a lot of taxes if you're in these different levels, and maybe in retirement you wouldn't be quite as high. For business owners, accelerate business expenses. You can look at Roth distributions and non-retirement account distributions if you're in these higher brackets to ease the tax burden. And then we look at tax loss harvesting for people that have non-retirement accounts in this area to lower the tax on a year-to-year basis. So I'm going to move on here, but if these slides, if you want to receive them afterwards, just shoot Kevin or I an email. We're happy to get them to you. So I know there's a lot of numbers here. So you look at things from a charitable giving standpoint and how you can be smart from a tax standpoint there. If you are age 70 and a half, as I mentioned, you can do this QCD, qualified charitable distribution. And the important point there is you have to be over age 70 and a half. You can't turn age 70 and do this, even though that's the year you might turn 70 and a half. You've got to be older than 70 and 6 months. So if you are doing that and you're claiming a standard deduction, which most of our country is because the standard deduction is so high today, that ultimately means that for any charitable contribution you're making, you're not getting a tax advantage. The way to get a tax advantage is through this QCD program. You can only do that in IRA accounts. You can't do that in employer plans, but that at that age, you could also roll previous employer plans to an IRA tax-free. So it's easy to get IRA assets if you have an employer plan. But option to avoid income from required minimum distribution once you get to RMDH. So that's the benefit of the QCD. And because you are getting those assets tax-free to the charity, ultimately, that's your tax benefit because you would have paid the tax on that distribution if you took it, but the IRS, but the charity is not. So it's kind of a quasi tax deduction automatically for you. So that's a very popular strategy as you get to over age 70 and a half. If you're going to give to charity, if you're not going to give to charity, then maybe you look at a different strategy. But for those charitably inclined, that's certainly one to look at once you're at that age. Looking at other things here, maximizing deductions for a certain year. You have the ability to lump charitable gifts into 1 year. So that's where people play the game called bunching. And bunching is when the goal is to not just take a standard deduction every single year, but to put all of your deductions in one calendar year so you can itemize that particular year. And then the next year, you take a standard deduction. So one popular way to do that is you take your the charity amounts that you want to give the next 2, 3, 4 years, and you say, I am going to contribute all of those this year into a donor advised fund called a DAF. You get the tax deduction in 1 calendar year. So it takes you from the standard deduction, allows you to go up above that into the itemized deduction level. And then you simply dole out that donor advised fund over the years, because you don't have to take it all out at once and give it to the charity that year. You can just take out a third or a fourth or a fifth or what have you, and just spread out the distributions from the donor advised fund, but get the huge tax benefit all in one year. So that's the benefit of that type of bunching strategy. You look at different types of Roth strategies. The first thing is kind of filling up these lower tax brackets. So as you think about that picture before that had those tax brackets, you think of those as different buckets. And depending on the bucket that you fall in, maybe you're not close to the top of that particular tax range, and you can fill up that bucket with a Roth conversion. So you maintain that current tax bracket that you're in, but you just have some more exposure to do a Roth conversion up to the top of that bracket. So we do that a lot of times in retirement years, as well, just fill up the current tax bucket, paying attention to the IRMA buckets as well. The second thing here, traditional or backdoor Roth contribution. That just says that if you are over the income level to contribute to a Roth, which if you think about that, I'll go to my chart here from a standpoint of the contributions for married filing joint. Once you make over 236,000, you get phased out of being able to do a Roth, and if you're single, it's 150,000. But if you're over those levels, you have the ability to do a backdoor Roth, which means that you contribute to a traditional IRA, which you don't get any tax advantage at that income level. So it's after tax contribution. And then you wait a day or two, and then you convert that to a Roth. So you kind of backdoor into a Roth. And it's important to not have any other pre-tax retirement accounts in your name. Otherwise, the IRS understands what you're trying to do and they get a little picky. But we're happy to help people with how to use that if you're curious. But that's a strategy which allows you to at least do 7,000 to 8,000 into a Roth contribution every year. Mega backdoor Roth, that's a very interesting strategy that if your employer allows it, which a lot of them do, and for people that have the excess cash flow, you can contribute up to the general maximum of an employer plan. And then you can go even higher than that because employer plans really allow contributions up to $70,000 this year. It's just that you lose the pre-tax nature of being able to contribute past that 23,000 mark. So then you contribute after tax money from 23,000 all the way up to 70,000 if you have that excess money. And then you take that difference and you roll it to a Roth right away. And that's a way to get a mega backdoor Roth where technically we've had individuals contribute $40,000 in their employer plan and fund that into their Roth through this backdoor Roth strategy. Fascinating. And different things. If you're a business owner, pass through business owner with net operating loss. You can use tax deductions, things like for charitable contributions and medical expenses to offset the income generated from a Roth conversion. So for people doing a Roth conversion every year, there's ways to try and minimize the tax burden that Roth conversion creates. And I won't maybe go through every one of these just for time purposes, but a lot of different types of strategies to get money into tax-free assets that we're happy to review with you. From a standpoint of considering domicile change, this is a discussion that we have with our clients sometimes that are looking to move. Do you just move into a tax-friendly state? Wisconsin is kind of middle of the road when it comes to tax friendliness. We're not great, but we're also not near the worst, like California, Illinois, New York, places like that. But some people look to go down south and move to a state that doesn't have any income tax, for instance. And if you look at doing that, there are certain rules that you have to follow that we can help with. But things like making sure you have a primary residence there. If you have employment, that helps. If you're registered as a voter, if you changed like your car registration to that state, tax filing and different licenses and things like that. So there's things that you want to do to say you're not trying to game the system because the IRS doesn't like that. But there's different steps that you can take that usually allow you to maintain tax filing in that other state, but still have a place here in Wisconsin, for instance, as a lot of people do that are the snowbirds of the world. But the burden of proof is always on the taxpayer. But if you follow some of these rules, you really shouldn't have to worry. Looking at different things like the estate tax that Kevin mentioned, there's not too many people worried about that today because the estate tax threshold is so high, $14 million per individual, basically. But if that is changing to 7 million, well, then more people are going to be affected because there's more people that have in between 7 and 14 million than that have at least 14 and up. The other thing to look at there in terms of the amount of tax you pay if you're in that level, it's very large. So an additional $7 million here amounts to an estate tax bill of 3 million. So it's almost 40%, 40 to 50%, which is a big bite to swallow. And that's where people start thinking about estate tax and saying, well, I really don't have to worry about that because I'm not at that threshold. The other thing that you kind of have to be concerned of when it comes to estate tax is if you live in a particular state that has their own death tax. And Wisconsin doesn't because we use the federal numbers. But I just kind of put these together here. I'll read off some of the states that have their own estate tax on the side. And some of them are still higher. Like Connecticut, they're at a $13 million exemption. So that's not too far off from the federal. If you're in the District of Columbia, that's 4.7 million. If you're in Hawaii, that's 5.4 million. If you're in Illinois, that's 4 million. So if you think about that, not too far from Illinois, obviously, if you have residents there, you might not be in the federal estate tax threshold of 14 million, but you might have over 4 million if you've done a good job accumulating, in which case then you die and you're going to pay Illinois estate taxes up to 16%, which is still not a small death tax. So again, ways to plan for that. But I was just going to read some of the other states before I move on. Iowa's actually starting to change their rules to the federal numbers, so not as big of an issue in Iowa. Maine is at 6.8 million. Maryland's at 5 million. Massachusetts is at 2 million. So Massachusetts really is the hard state to live in from that standpoint. Minnesota is at 3 million, not too far away for Minnesota state residents. So yeah, just wanted to mention that it's not only federal estate taxes that you have to worry about, but you got to think about state as well. So if you are not subject to federal estate tax, which not a lot of people are, what are the considerations then? We still want to have key documents in place from an estate planning standpoint, get out of probate by having things titled correctly, focus on maximizing the step up in cost basis. So we recently had a 90-some-year-old that had a very large stock that he put very little money in, and it had done extremely well. And he was looking to sell all of that, in which case we said, I mean, not to say the obvious, but you're not going to live till you're 200 years old. And we may not want to take that big of tax bite because then the step up in basis is not being used at all for when they die. And because they really didn't need a lot of that money, the step up really was something that they needed to consider. Strategies to mitigate impact of the Secure Act 10-year rule. So some people don't like the fact that their kids would have to pay the taxes on their retirement accounts. I have other people that say, hey, it's money they didn't have in the first place, and we don't care. So, but if you are someone that maybe wants to pay the tax ahead of time, you can do that through Roth conversions. Sometimes you have to look at the tax brackets that your kids are in. Like sometimes the kids are in the higher tax brackets than the retiree parents are, in which case adding extra money to their tax bracket could mean you're taxing that at 40 or 50% level. So that's something to consider. Potential state death taxes, kind of talked about that with some of those states that are affected from there. And then obviously, if you're in the range of paying an estate tax, well, then there's really more advanced estate planning you have to do with trusts and things about getting money out of your estate and gifting. And that's certainly a good problem to have, but I won't cover each one of those. So if you are looking at that 10-year rule as a retiree, first thing you want to do is be careful of the designation of the beneficiaries in terms of who's getting that money and will that give them a 10-year rule or not. So depending on who the beneficiary is, like spouses won't have to worry about that 10-year rule. But if you have one child that's in a high tax bracket and one child that's not, maybe you give the child that's not in a high tax bracket the retirement asset and maybe some other asset to the child that is. Again, just so the IRS doesn't get a majority of the money. So there's different games that can be done there from a beneficiary standpoint. Tax efficient timing of IRA distributions for heirs. When does it make sense to withdraw over the 10-year period? So if you inherit a retirement account, which a lot of our clients do, you've got to be careful in terms of how you take that money out. You don't want to just take out the minimum that's required, because otherwise the last day of the 10th year is a tax explosion. So you've got to have more efficient distributions over that 10-year period up and beyond what the IRS forces out. Or the IRS is just going to get up the lion's share in 10 years. So we have that discussion a lot for people that inherit a pre-tax retirement asset. But if you inherit a Roth, you easily could wait until the last day of the 10th year because it's all tax-free anyway. Advanced strategies to consider. You can leave an IRA to a charitable remainder trust. If you have charitable desires, or life insurance is a way to help pay a tax bill. If that's something that you're not using the required distributions for anyway, some people leverage it up by tax-free death benefit. And that's a nice asset to leave that. So we're at 450 right now. The rest of these discussions really have to do with kind of different things that you can do if you're in that federal estate tax threshold. I maybe won't spend too much time talking about that. It probably is more of a one-on-one conversation if you do want to dive into that, because it's interesting, but not at a point where a lot of people are using those strategies yet. So I'm going to stop sharing here and I'll stop recording.